Down more than 70% from its all-time highs hit less than a year ago, Netflix investors are reeling. What's going on and what you can expect going forward? Coming up. Welcome back, you amazing 17,000 subscribers. Many of you have asked me about Netflix, and so because I love you, I dug in there for you. Here it is. After their disappointing subscriber miss in Q4 2021, legendary value investor Bill Ackman, seen here taunting Carl Icahn about the size of his assets, jumped in, buying up more than 3 million shares of the stock to demonstrate his discipline as he waited for a rebound after Wall Street's overreaction. Well, turn that rebound upside down and you've got a falling knife that Ackman just threw his investors under. Turns out that Q4 21 report was not just a blip in subscription growth, it was a turning point. The Q1 2022 earnings report revealed much more of the headwind with which Netflix is faced. They lost subscribers for the first time in more than a decade, about 200,000. Not great, especially when they were forecasting adding 2.5 million. And now they're guiding for an additional loss of another 2 million over this next quarter. So Ackman cut his losses, losing more than 400 million for his investors in a matter of a few months. It happens, even to the best investors among us. But you're not here for Ackman, you're here for Netflix. Losing subscribers is a big deal for a company that has leaned on subscribership growth to defend its outsized content spending relative to its peers. Now, although total US TV time spent on streaming video on demand, SVOD, is increasing, Netflix is faced with more and more competent competition. And the COVID lockdowns, although they benefited Netflix, they also really helped boost all these other major players who were pushing out their own competing platforms during that time. The Netflix story is an impressive tale of innovation. They should make a documentary about it. That'd be pretty meta, right? Netflix's Netflix documentary. Anyway, in case you're not familiar, in 1997, they pioneered the DVD rental by mail model. I go slowly because I know some of you younger viewers may have to Google some of those words. Supposedly, they were inspired after founder Reed Hastings, seen here resting in his living room, racked up a $40 late fee at his local Blockbuster. In 1998, Jeff Bezos offered to buy the company for around $15 million. Hastings, being the majority owner, refused, even though the other owner, Mark Randolph, was inclined to take the offer. In 1999, they innovated again and switched to a subscription concept. In 2000, they offered to sell the company to Blockbuster for $50 million and were effectively laughed out of Blockbuster's corporate offices. They went public in 2002, started realizing more and more of a profit, and continued to innovate. In 2007, they began to experiment with the idea of streaming video on demand. Interestingly enough, if you think about it, this was a self-disruptive move. The success of SVOD would inevitably eat into their DVD by mail subscription model. But unlike Kodak, who invented the digital camera but then tried to kill it because they were afraid it would kill their existing business model, Netflix leaned in and benefited from being a first mover. Over time, however, as more and more competition began to enter the space that they pioneered, they began losing valuable contracts for content. They realized they needed a massive pivot to remain viable long-term. So in 2013, they entered the content production industry, debuting their first series, House of Cards. Since that time, it's been pretty much the same story repeated. Netflix continued to expand into more and more countries. They're in almost all of them today. They continue to penetrate more and more of each of those respective markets. And every now and then, they would increase the cost of their service. Seen as how they were the only real game in town, of course people would continue to pay. But seeing their success, predictably, more and more competitors followed their lead, which naturally led to Netflix losing more and more legacy content deals, as the original owners of that content are those competitors deciding to enter the SVOD market themselves. And that brings us pretty much to where we are today. The demand for SVOD continues to grow, which is obviously good for Netflix, but their future dominance in this market is not as obvious as it may once have been. For years, when you listen to earning calls, management almost pretended as though the new streaming services coming online did not present any real threat. More recently, they started to at least acknowledge their existence and that maybe they are doing some cool things. But now when you listen to their most recent call, it sounds like they're in full crisis mode, and they probably should be. Of course, you would expect their growth to slow over time, as big as they are today. but it seems to have slowed much more rapidly than management anticipated, at least than they previously let on. The US market has been stagnant for some time now, and in fact, when you look at the breakdown, last quarter they lost subscribers in 3 of their 4 regions. Sure, some of this is just the natural consequence of them being the largest player in this space. It's not unreasonable that they might grow slower, but that's not all that's going on here. In its Q1 22 earnings press release, Netflix acknowledged higher household penetration combined with competition is creating revenue growth headwinds. Let's explore their competition problem a little more. Today, they're facing some behemoths with deep pockets. I'm talking rivers of cash flowing from sometimes multiple other parts of their business, and vast content libraries that they've built up and or acquired over decades. Their competition today includes Apple TV, Hulu, Disney, Amazon Prime Video, HBO Max, Paramount, Peacock, and others. I'm sure I'm missing some other big ones there. But think about what I just said in the context of those companies that own each of these platforms. Think about their massive cash flows from other parts of their business, Apple, Disney, Amazon, to support their growth in streaming, eating away at Netflix's market share. In 2019, Netflix accounted for more than 64% of this market. By 2021, it was just around 50%. And think about the enviable content libraries some of these competitors already boast. Disney, HBO, Paramount, Peacock, content to which people want access, much of which used to be on Netflix. Netflix's strategy of late has been to out-create. They burn through cash trying to constantly feed a binge model with a subscription service. Think about that. People are becoming more and more sensitive to their monthly obligations. I get that the binge model is attractive. It's something Netflix prides itself on. But it makes it much easier for someone to just pay for a single month out of the year to keep up with the absolute latest episodes of their favorite show, versus spreading out air dates over several months. That seems more conducive to the subscription model to which they want you to remain committed. If they made that change, yes, people would initially be upset. But then their challenge would be to create, say, at least 3, maybe 4 titles released at different points throughout the year that a household likes in order to keep them paying every single month, year after year. And they may already be doing that for many households. But as it stands today, I know there are a lot of people turning their subscriptions on and off based on when content is launched, and then just making sure they binge it all within a month's time. So if Netflix keeps that up, they're just going to have to create that much more new and expensive content, like 3 or 4 times as much. And while Netflix outspends everyone on new content creation, some of their competitors have just opted to buy large content libraries with attractive titles. Think the merger of Warner Brothers and Discovery, or Amazon's acquisition of MGM. In the past, as we discussed, when they were facing steep competition, Netflix disrupted, and it's a similar management team in place now. They disrupted even to the point of self-disruption. That gets harder to pull off the larger you are. And if I were a Netflix shareholder, I might be a little afraid if they just continue to maintain this obstinate paradigm of just out-creating the competition. They're at a point where, and the recent trend seems to confirm that, it's going to require higher and higher spending on content to sustain a smaller and smaller subscriber growth. Their old strategy of just raising the price a little every so often seems to have been a major contributor to their recent subscriber decline. And that makes sense, considering the fact that at this point, they're pretty much the most expensive option out there. They obviously need to pursue some different angles, and I believe the decisions management makes here will make or break the future trajectory of this stock, whether it takes off again or whether it just matures, as the market seems to be suggesting right now. Here are 2 more things that have been posited that they could do to potentially change things up a bit. One, they've mentioned considering, despite years of Reed Hastings harping on the value of their ad-free model, a lower tier ad-supported offering. Several of the other players in the market have been able to successfully implement this type of SVOD service. The challenge for Netflix is that they're not currently set up for that. Successfully incorporating ads into a streaming experience is something they'll have to implement with care, so they upset as few people as possible in the process. If they try to do it all in-house, that'll be incredibly expensive. It would probably make more sense for them to utilize existing players in this space, like the Trade Desk, for example, ticker TTD. I could definitely see them offering a lower priced ad-supported tier without disrupting their existing subscribers who would just prefer to pay the premium for the same ad-free experience they have today. That seems like the most logical path for them to take in the near future, as unexciting and not very innovative as that may be. 2, they could also look into some live sports content. They are one of the few streaming platforms that doesn't even try to do this. Disney, Amazon, Apple, CBS, NBC, Fox, each of which, as you know, has its own streaming platform, are securing rights to more and more live content. It's expensive, yes, but the high price tag hasn't stopped Netflix in the past. And although it doesn't maintain its watch value for long after it airs, sports seasons can create that stickiness, like I talked about earlier, that you want when trying to run a subscription-based service. And if they're really thoughtful about it, they could also have some opportunities for some synergies here. For example, Netflix's F1 docuseries supposedly boosted US viewership to the sport by 40 to more than 50%. But who benefited from that? Disney's ESPN and others, not Netflix. It's just an idea. And I know Hastings has mentioned looking into it in the past, but he's very particular. Last year he said Netflix would require exclusivity that is not offered by sport leagues in order to offer our customers a safe deal. So we'll see. On the innovation front, they've given us insights into a couple of things. One, they're complaining a lot about password sharing, much more than any of their competitors, and are going to try to find a way to crack down on that. Again, something that competitors might be able to copy if they do it well. Hopefully, they don't upset too many subscribers in the process. But the other, more exciting innovation, too, could be the seamless addition of gaming to their subscription offering. They've talked about moving this direction. They've hired executives specifically to work on building this out. They've even acquired game developers. We'll see how this plays out. As with any of these tech innovators, with most good innovations comes great risk. Now we're about to jump into the numbers, so a quick legal disclaimer here. This really is not investment advice. I walk you through everything step by step to help you better develop your own investment analysis skills. I'm absolutely not recommending you buy this or any other stock. You must perform your own due diligence. There's a link to all my disclaimers and disclosures in the description. We good? All right. As far as fundamentals go, Netflix is much more attractive than the last time I covered it in June 2018. We're going to analyze Netflix, and we're going to do it all in 90 seconds. Their share price and market cap are about half what they were back at that time, and yet their subscriber count is now almost double, more than 220 million. Consequently, their PE and PB ratios have come back down to earth. At that time, they were 236x and 39x, respectively. We can pop over to Simply Wall Street to see their current list price under $200 with their market cap around $85 billion. As I said, their PE ratio has come back down to a normal range where now it's around 18x, which compared to its peers is actually low and is very close to the market average. Its PEG ratio is 1x, which is actually pretty good for a high-tech growth company, and its price-to-book ratio has come all the way down to around 5, where before, remember, it was almost 40. They're still projecting, and analysts are still forecasting, healthy growth going forward that would turn into a respectable future return on equity. They have an incredible track record of growth in the past, which of course is what's in question here, about whether or not they can keep that up given the current state of their subscriber growth and competition. But in the past, they've proven to be good stewards of capital, producing a high return on equity compared to the market. 28.5% compared to the industry's 10.5%. Their profitability metrics look pretty good all around. One final thing to note here is the relatively sizable stock purchase from Reed Hastings within this last year. It was about $20 million worth of shares. Of course, he did make more than $43 million last year, so take that for what it's worth, but it's not a bad sign. It is, however, concerning that almost no one else in the executive team or on the board of directors, except maybe one guy, owns very much of the company at all. Now, from a technical perspective, this stock does not look good right now. Its 78.6 Fibonacci retracement level was around 211, and the price of this stock has already gone more than 5% past that. Really, all around, the technicals are screaming for the faint of heart to stay away, at least for now. All right, for the really fun part, at least for me, let's go behind the computer real quick, and I'll walk you through some of the numbers I used for a really quick bare bones valuation. All right, so I created a new Netflix tab on our stock analyses window that at some point I will make public. I know you guys keep asking me for it. I want to make sure that I want to make sure it's right before I do that. I don't want to lead you down a wrong path. So first of all, let me show you some of the numbers that I pulled together over here on the other side, and let me walk you through this information. I know it's not pretty. I didn't take the time to make this pretty for you. Sorry. I pulled this information from SeekingAlpha, and if you're not a paying member there, you should be able to get, if you go to the individual stock here, so I have Netflix pulled up, you should be able to go to their financials, and I believe you get the last 5 years that they show you. Obviously, you can get this information from wherever. You could go straight to their 10Ks and pull that up, but that's often very difficult and clunky. One thing I like about getting it from SeekingAlpha is that I can just highlight this row, I can copy it, and then I can pull it over here and paste it. And so now I have that information right here, and then I can create my own change in value here that you can see the formula that I'm using for that. I'm gonna go ahead and undo what I did there, but I thought I'd share that with you as far as where I pulled this information. You can also, just in SeekingAlpha, change the view from absolute to year-over-year growth, and then that'll give you the idea of the percentage changes. The reason why I pull it over here is because I want to see the averages, and you've seen me do that in the other analysis videos in the past. I'm going to use those averages to get an idea of what is a reasonable growth rate. So this gives me a view into the past, and then everything that we just went over is all the present, everything that's going on in the present, so that I can best piece together various scenarios that I might expect or that I might view as reasonable for the future. And so I can mix that information that I have and the numbers I have from the past to create those options going forward. So that's what I'm trying to do here. It's not an exact science. And if I decided, so I'm just going to do this with one valuation methodology. I'm going to go into detail here so that you can see exactly what I'm doing. In some other analysis videos, I've gone more in depth. On the one with PayPal, I did some other analysis methodologies, and sometimes when I feel so inclined, I'll do that with other ones when it makes sense, when I see a good opportunity to do that. Before I invested, if I decided at the end of this that I was going to invest in Netflix or that I wanted to, and I was still going down that path, I would then try to find 2 or 3 other ways of valuing it and take myself through this exercise again, but with a separate methodology. I could then compare the values that I'm getting from different ways of analyzing the stock. So I'm not saying this is the absolute only way to do it, or even necessarily the best way to value Netflix. I get some things wrong. I look at a lot of different stocks, a lot of different companies. I only piece together videos on some of them, some that you've asked me for. It takes a lot of time to do that. So definitely let me know in the comments if you have any insights, about something that I've done here that I've messed up. Let me know. I would love to share that with everybody else, because I don't want to mislead anybody. Or if you see a better way to look at it. So I was looking for numbers that I felt like told a clean story, one that could give me an idea of what I might expect in the future. So we have a lot of information going back a long time. These were the numbers that had a pretty consistent rise. Of course, you look at the related ones here. You have revenue has been consistent from the beginning. You look at those numbers; it's pretty impressive that they can continue to do that year over year, somewhere between 20, 30%, 35% growth every single year. That's impressive. Obviously, now they're spending a lot on content creation. They have a lot of other things going on that ultimately affects their net income, which has been a little bit more variable, but very impressive. And then that ultimately goes into their diluted earnings per share, which has had a similar growth rate as net income. Now, I ultimately also pulled over the levered free cash flow figure because I thought that told a pretty clean story of what they've been able to do in the past. The reason I didn't look at operating cash flows, you can come over here to the cash flows and see cash flows from operation. They're kind of all over the place. So that would make it very difficult to get an idea of what to expect going forward. And it is very difficult to come up with valuations when you have a lot of negatives in there. anyway, take that for what it's worth. Obviously, it's nice if all of these numbers are all positive all the time. They're usually not, and I usually won't invest in a company if my free cash flow and there's no profit. If all of those things are negative, then I will avoid it, because it is so difficult to come up with a real valuation that I can feel confident in. A lot of people, analysts, when trying to come up with valuations there, will look at revenue, for example, and you can do that when that's the only thing that you have, but that's the most disconnected from actual value to me as an owner, as a shareholder. Anyway, there's my old man value pitch on that. These are the numbers that I pulled over for those reasons. They're out of order. Sorry for that. But again, I just wanted an idea of how revenue has grown over the years, and then also to be able to see it here all next to it, so I can see if there's outliers. I took out the two outliers here early on. I think they raised the average to mid 80s, maybe around 90%. But the number, like I said, the number I want to use anyway was my levered free cash flow. That's the variable that I want to use to think about how it's going to grow going forward. So some other information that I needed. I wanted to know the shares outstanding, which you can also pull from. You can pull all of that information if you want to see how that's changed over the years from their balance sheet over here on SeekingAlpha. So I got the total shares outstanding that I pulled over. And I can see that they've increased on average 1.5% per year. So not too much dilution that's happened in the past. Now in the future, they have talked about buying back shares. And they've started to do that. And so that's something that I want to factor into my valuation going forward as well. And again, it's a guessing game. It's, your guess is as good as mine as far as what they're actually going to do. And so I want to think through it logically and figure out something that makes sense to me, that I'm comfortable with. And then every earnings report, pay attention to what they actually did and adjust my expectations and my valuation accordingly. Okay, so we'll come back to this buyback information here in a second. I'll explain that. But now you have an idea of where I'm going to pull my growth figures from. I'm looking at this leveraged free cash flow. And I see that here recently it is kind of all over the place, which again, that's something that I'm looking at. The recent numbers, obviously we had COVID stuff and that, juiced it up and then brought it back down. But if I look at the difference between 2018 and where it is today, that is just under a 30% average growth rate as well anyway. So I know they're getting more and more competition. They had some competition back then. They still have competition. They're still able to churn out about a 30% growth rate from the free cash flow perspective. So that was something that I considered. I did look shorter term from here to here just to see what their growth has been there as well. And then obviously it's been consistent before, but they didn't have the same headwinds back then. So that's the information that I'm using to pull my growth figures. Then I need to figure out what my terminal multiple would be. I'm going to be growing this free cash flow per share figure into the future. That's what I'm trying to estimate for my base bull and bear case. And then I need to be able to convert it back to a share price in the future that I can reasonably expect to sell it for. So I want to know what their price to leverage free cash flow has been in the past, what that ratio has been for them. Now, a decade ago in 2012, when they were they hadn't gotten into content production yet, they were still kind of untested, still people were not sure about them. They had a 3 price to free cash flow ratio here. But since that point, it's always been quite a bit higher. Today, it's actually lower than it ever has been, except for a decade ago. The average over this time period has been just under 11. So that gives me an idea of a terminal multiple based on these different scenarios. When times were pretty good, and it was receiving a high valuation, 13.32, 12.47, 13.8, and then of course the COVID years, which I'll probably not go that high for my bull case, just because those are obviously the outliers here. Okay, so now you have the context. So now I'm going to go back over to my chart here and plug in and tell a story based on the information that we just went over. Tell a story about what's going to happen in this base case, bull case, and bear case, and then figure out which ones seem most likely to me to happen. So if I'm coming up with growth rates, as we saw, we had a 30% average growth rate historically for this trailing 12-month leverage free cash flow per share. If I think about going forward, and I want to be conservative, they have way more competition. They've expressed very few things that really strike me as incredibly innovative. It's not like the Facebook story where they have this really big vision of something that most people don't understand or fully grasp, and you're just trying to trust them, or kind of just hoping that they know what they're doing because they're visionaries, whatever. They haven't really pitched anything crazy like that here at Netflix. So I think even in my bull case, I'm not going to assign them a growth rate like they've had in the past, where they were the first mover into this space. They were incredibly disruptive. But now, as with any company like that, when you have a lot of success, now they have all this competition coming in, as we already went over. So I think my bull case scenario, again, even with all of these, even though it's my bull case, I'm going to try to be conservative and say that they grow by 22%. Yes, it's random. I made that up. I don't know. But again, historically, I have the context. They've been growing by 30%. Let's say they're able to crack down on passwords. It doesn't make too many people angry. They're able to move into the gaming market as well. They do it successfully. They continue to their content creation strategy. They make some adjustments. Maybe even they innovate in a way that they haven't even talked about. I'll give them 22% growth year over year over the next 7 years. Right? So that's the average that I'm anticipating over the next 7 years for my bull case scenario. As for the base case, I know the analysts are being a little bit harder on them. They put the growth rates in the teens as far as their projections. I think I'm going to be even harder on them and say, what does it look like if it's only a 12% growth rate? So again, I'm trying to be conservative, but within the range of what I think is reasonable. That would be impressive if they're able to average that over the next 7 years, a 12% growth rate. I think that's definitely doable. I think they should be able to do higher than that. But again, if they don't pivot, more and more of their profits are going to get eaten into. And then finally, for the bear case, I'm picturing a scenario where people start to cut back more. Netflix is more expensive. And so they are quicker to cut Netflix than they are to cut Disney. Keep the kids happy with Disney. That's fine. And I'm thinking more of a macroeconomic scenario that maybe takes longer to play out than I might necessarily expect. I'm expecting large macroeconomic events, like I've talked about in other videos, that I think will affect growth stocks, especially high-tech stocks like Netflix, going forward. I'll talk about that in a second after we're done with the valuation. But with all of that in mind, with that macro picture in mind, I'll give it a 6% growth rate there. So I have some extremes there. As far as terminal multiple goes, again, we looked at on the bull case scenario, I'll put it not COVID times highs like it was, the 18, 19. We'll put it where it was high every other time. Every other time it was elevated, it was around somewhere between 12.5 to 13.5 of a multiple here. So I'll give it a 13 multiple. For the base case, we can say, it does well, but it's starting to come down. And so I'll give it the multiple that has been its average. Its average was almost 11. Let's go with 10. So that's been its average multiple here over the last decade. And then for the bear case scenario, I'll go on the low end. If you'll remember, the lowest was a 3. I won't go quite that low, but I'll go a little bit lower than it is today and say that it's only a 5. So today it's about 5.45. Okay, so now we get to plug in our number here, our multiple, and first we need probabilities. Okay, so I think this bull case scenario, from what I've seen now, I may change these probabilities in the future, but from what I've seen, from the things that management have said, like I said, I feel like they're more in crisis mode versus actually knowing exactly what they're going to do to solve their problems. I don't doubt their ability to come up with something in the future, as they're very competent. They've proven themselves competent in the past, but I'm going to put this bull case scenario at a little bit lower probability than I will the bear case scenario. Again, I think the macroeconomic picture is even more concerning to me, which makes me more bearish on just stocks like this in general. even though I think this is a great opportunity in the sector, which leaves 70% for my base case scenario. Okay, now the fun part. We had the leveraged free cash flow, the trailing 12-month figure per share that we looked at earlier is 36.48. We plug that in, boom, it populates our chart here. So you take a while to soak that in. This is the current price down here. You can see it changing. It is tied to Google Finance, and the terminal value. I think we've talked about how we're doing this in the past, so I won't spend any time there, but I do want to talk about the buyback adjustment because that's something I haven't done in a video in the past. And so all I did here, first of all, let's jump back over to the buyback scenarios, and you can see how those work. Okay, so they've talked about doing $5 billion in buybacks. And I'm assuming if cash flow continues, then that's something that they should be able to do into the future. And presumably if things go well, they can do more of that if they're generating even more cash flow. If things go poorly, if they start to lose money, lose market share, they will do less of that. In fact, they may go back to increasing their share count like they have in the past. So those were the thoughts going through my head here. I wanted to know how much $5 billion, how many shares that would buy. And so I just, I looked at dividing that by the current share price, it would buy about 25 million shares of the 444 million that are out there. Over 7 years, that would get us 177 million if they did all of those buybacks. Now, if it got more expensive, so if the stock price goes up, it's getting more expensive, that 5 billion is buying fewer shares, right? But if over the coming years, if over the next couple of years, it remains low or goes lower, it could go lower over the next couple of years, then that 5 billion, if they're still doing it, if they follow through with that buyback plan, which they presumably would, they'd be able to buy more shares, and that would push up the share price. But anyway, so what I looked at here was a base case scenario where they're able to do half of those over the next 7 years. So there are 89 million less shares in that scenario. In the bull case, I did 75%. Again, it's as it starts to get more and more expensive, the share price, they will buy less and less, but also they will presumably have more cash flow to be able to spend here. And then the bear case, all I did here was look at this 1.5% figure. What if they had to grow at that same rate going forward? And that's actually increasing the share count instead of a negative here, because we're talking about buybacks. So if you zeroed these out, just so you can see how this works, if you zeroed all of these out, and then we come back over here to this chart, you can see that the buyback adjustment leaves it where it is in year 7. And then we pull the terminal multiple from that. Let me undo those changes, and you can see what the buyback adjustment is doing. So all the buyback adjustment is doing here is taking this final number that we have, because remember that's a per share value. It's multiplying it by the number of shares in existence today to get it back to the full leveraged free cash flow figure that we would have here. And when I looked at it, it's about 35 billion that we're projecting at this point. Today it's around 15, 16 billion. So that checks out for that growth. And then we're just going to divide it back down to a per share value, but we need to take it down after adjusting for the reduced number of shares. So whenever we divide that by the previous number of shares, you can see that down here, minus the ones that we're saying they buy back, then that leverage free cash flow figure is now higher per share than it was. And then we take the terminal multiple from that number instead. And we did the same here where we had the higher share buybacks, they're even more, so it has an even greater impact. And then it actually has a negative impact here on the bear case where they ended up having to issue more shares. So there are now more shares outstanding. And so it actually makes that number worse. Okay, with that information, here's what we're looking at. You have a downside here that would still give you a positive ROI, right? It would be worth 240 $7 versus $197 that you buy that today, but that's probably not a very exciting rate of return. It's definitely not for me, but you have a significantly higher potential for return with the other scenarios. So your goal here is to figure out what makes sense to you with that story. That's kind of the process that I'm walking through for myself. And if I felt a higher conviction in this story on the whole, and I'll talk in a second why I'm avoiding it right now. But like I said, I would then take this stock through the same process with a few other ways of valuing it, looking at it from different angles to see if it also told a similar story, or if there were some things that weren't aligned, and so maybe I'm missing something. But once you do that, if it all looks favorable and you've been honest to yourself as you've put together this information, then you can have a much stronger conviction as you enter the position. Now, I personally would wait for the technicals to be more aligned before you entered, so that you're not immediately suffering more of that downside potential that is definitely there. But that, every investor is a little bit different. So I hope that helps you with your process. That's what we're trying to do here. So when it comes to Netflix, on the whole, I'm relatively bullish, which is weird for me to say because for a long time I could never have imagined holding a stock like Netflix. It's always been too much of an out there growth stock with crazy valuations, and that's not really my cup of tea. But I think the valuations have come back down to earth. They have a great track record of sound management and growth. And so there's really no reason from a company perspective to not expect that to continue, at least to some degree, as I talked about when I explained my reasoning behind my valuation. But given the macroeconomic picture, some of the things I've talked about, the concerns I have that I've talked about in other videos, it's not an investment I would take on at this moment in time. I think they're going to have some additional macroeconomic headwinds ahead of them as well, along with many other growth stocks. But in addition to being a growth stock, I'm also concerned by the fact that they have one product offering, and that product is not a necessity. And so as inflation continues to ramp up, as I expect it will, I'm afraid a Netflix subscription is going to be one of those things that for many households, that more and more of them, more and more families might just choose to live without it for a bit. I don't, however, have any concerns about them going away or being in a too precariously leveraged financial situation or anything like that. So for a long-term value investor who is interested in a little growth, adding a little growth into the mix, this could be a good holding. But I do think there are some risks you should be aware of before taking that position that I just talked about, that you'll be faced with over the short term. Whatever you do, I wish you all the best. Thank you so much for being here and watching this whole video. If you found this valuable, I know you'll appreciate these deep dive analyses as well. I look forward to hearing from you in the comments and getting to know you better over time. Thanks again. Take care.